Hello everyone, my name is Kamal Manocha. I represent PMSAIF World. In the rhythm of weekly webinars, this week we have kept it with Abakkus because Abakkus has more than 5 years of history in the listed space. They have been known for doing alpha focused investments and purely doing value investing. But for the first time, Abakkus has actually created a new division and launched Category 2 fund in the private equity space where they are going to do mid-stage to late-stage private equity investments. For the same, Ankit Aggarwal, who is one of the speakers today and the guest today for this webinar, is the one who has been, part of Abakkus now, and he's joined Abakkus from Kotak Institutional Equities. He brings with him more than 16 years of experience and pertinent and particularly in the private equity space. We'll know more about the fund. But before that, want to understand the entire thought process of Abakkus, why this fund and how and why they have named it like 4 to 8 Opportunities Fund. Welcome to this webinar, Ankit. We do these webinars every week and we have created a niche in this industry, in the space of alternatives. So this webinar treat like more for education purpose for, our audience who would more want to understand the thought process of Abakkus, for coming in this particular space. And what value you are expected to add in this entire, I would say, fund, when Abakkus is wanting to raise money in this fund, and what is the kind of, I would say, risk one should expect when one is kind of wanting to understand in this fund and wanting to invest in this space. So these are some of the more, I would say, educational, I would say subtopics in this entire webinar that I want you to cover. Maybe broadly, you open it up by talking about yourself in terms of your background and what value you think you are going to add in this fund, and then we'll take it on from there.
Sure. Thanks so much, Kamal, for the opportunity, and thank you, PMSAIF World, for taking the time and listening to what we're doing, what we're planning to do on the private equity Cat 2 side. So the fund which I will talk about is Abakkus 4 to 8 Opportunities Fund. I'll talk about my background in a couple of slides, but just want to sort of highlight the opportunity which we are looking at, which we think is a massive opportunity. So India took about 77 years to reach today's $4 trillion economy, but we are expected to replicate this in the next 7 to 8 years. So what India created in 77 years is expected to happen in the next 7 to 8 years itself. So there's a massive economy and wealth which will be created over the next 7 to 8 years. Simple math is a real GDP of about 7% plus some inflation. So the 8 trillion is definitely achievable for India as an economy. When we look at what are the key drivers, there are 4 Ds basically, which is strong democracy. We have a stable government, very domestic consumption, which is very strong for India. We have a very great demography, which we have a very young population, and because of focus by both government as well as private sector, that digital dividend is also something which will really benefit from. As you know, Abakkus as a asset manager, we manage close to about 30,000 crores on the listed side. We've done extremely well on the public market side. And our aim is to find opportunities also on the private side, and I'll tell you more about it. Obviously, Abakkus as a platform has been started by Sunil, very marquee investor, and where we have sort of taken it, where he has taken it to this level. My background is I'm a computer science engineer by background, and I did my MBA from the Wharton School, University of Pennsylvania. 16 years of private equity experience across India, US, and Israel. I've worked in groups such as Fosun, George Kaiser Family Foundation, Lighthouse, and my last role was a director at Kotak Alternate Asset Managers, managing a 2,000 crore private equity fund. In terms of the opportunity, our aim is to invest in mid to late stage companies, basically companies which we believe have an IPO possibility happening anywhere in that 6 months to 2.5 to 3 year period. We'll also look at secondary opportunities if there are private equity funds which want to have an exit because they're coming to end of their life. And also we'll look at opportunistically pipe transactions which need that growth capital. Just to let you know that our philosophy, which has worked extremely well for us on the public market side, we are going to stick to the same philosophy on the private equity side as well, which is to invest in great companies, which is run by great founders, where we're coming in at much more reasonable valuations. Aim is not to invest in loss-making companies and basically providing them capital to burn. Aim is to invest true growth capital, which will help them to reach the IPO stage, and then when they go IPO, that's the time when we get a liquidity event. We may decide to list at that time, or we may decide to sell it or that time or not. We'll take a call on that depending on the valuation of the company upon listing. But we have no compulsion because we are a Cat 2 fund. There is no lock-in for us when it comes to this particular category which we will be running. In terms of the various stages in the investment landscape, there are companies, there are lots of funds. We think there are lots of domestic and global funds which come in that VC stage, venture capital stage, or that growth stage, which we believe there's a lot of capital, but either the business is still getting figured out, unit economics are not very clear. So business model is still getting figured out, or the money is needed to fund the losses. Then obviously there are companies, when we look at the listed market, there's a lot of capital availability. Also, once they go for their listing, large pools of long only capital is also present. We believe that there is a sweet spot in that mid to late stage segment where there's not a lot of focus area. We believe that there will be an illiquidity discount which we'll end up getting, and where we believe that the liquidity event is also much closer. So I think this is a very interesting area where we feel it will benefit our investors. Obviously, very advantageous for all the stakeholders when it comes to the late stage companies. Value, it's a great value for the company in terms of benchmarking, for the promoters, for liquidity, and PE funds if there are any, in terms of exiting a little bit and getting some partial liquidity. We are going to be a sector agnostic fund. We'll look at companies across sectors, but some of the key themes which we feel are going to benefit from that $4 to $8 trillion journey for India are manufacturing, infrastructure, consumer, healthcare, financial services, and so on. So we believe that there is a massive opportunity there. In terms of companies, we already are looking at a couple of interesting opportunities when it comes to our fund. One in the mining EPC space, really good company, good valuation we are getting. And the other one is a high-end engineering aluminum products company. Again, double-digit EBITDA margin, good ROE profile. So these are a couple of companies which we are looking at from our fund standpoint as a run-up to the fund. In terms of the deals, the three pillars which we have, which we believe are our advantages. One is the differentiated deal sourcing, where we have a very large ecosystem and network through which we'll be able to get the right transactions. We will stick to our meets framework, which has worked extremely well on the public market side. So aim is to invest in, as I mentioned, and I'm just at the cost of repeating myself, we'll look at profitable businesses with good return ratios and good growth profile, good management team, and so on, right? So aim is to invest in those sort of companies. And in terms of, again, the aim is to create that alpha. Our aim is to create alpha of 6 to 8% over the public markets. And that is basically what we are aiming at. And we have strong processes in place which will ensure we'll have diligence done, business diligence, commercial diligence, and basically legal, financial DD as per the need of the company. And we'll ensure that we have checks and balances in place so that we can provide exit for our investors in the fund. In terms of Kamal, may I also talk about the fund, life, etc., also?
Sure. You can maybe spend more minutes, 5 more minutes, and then we'll start with Q&A.
Sure. So just to let you know that the fund which we are targeting, it will be 1,000 plus 1,000 crores, about up to 2,000 crore fund, where the minimum check size of about 1 CR. Commitment period is 36 months, but we anticipate the investment will happen in 18 to 24 months. And it's a 6.5 year fund. We are anticipating a typical check size will be anywhere between 50 crore to 150 crores, where we basis our fund size, we anticipate about 15 to 20 odd companies in our portfolio. And yeah, I think that is about it. Right, I think that's about the fund. Just to let you know about also the recent budget which came out, that has actually put the taxation at par with the public markets. So that's actually a big benefit. So in case we want to exit, certain private equity funds want to invest in a company where we've already invested, that also provides a big advantage to our investors, because the taxation for Cat 2 is quite attractive also now. So that's about, I think, about it. Happy to take any questions if Kamal.
Sure, Ankit, sure. So just, if you could stop the screen share.
Yeah.
Perfect. So I think this is really helpful to begin the context. The foremost question, if I put myself in investor's shoes, is that, we know Abakkus background, Abakkus track record, but we do not know your background. And now a lot of things are going to be in your hands in terms of your track record is what, is first thing which comes to my mind, when you used to work in Kotak, or you mentioned, before that. So if I was to understand, what has been your track record in terms of whatever deals you have done in the past, how do I kind of comprehend that?
Yeah, no, so Kamal, basically started my journey back in 2006, investing in companies in the hospitality space, industrial space, consumer space at Lighthouse. Then when I was based in the US, I invested in companies which were tech-enabled businesses based out of Boston and out of Tel Aviv, Israel, where the companies ranged from medical device to companies in the wireless electricity space to laser diode for cutting and welding. So across industries, and then came back to India and invested in the logistics space. And one of the deals at Lighthouse, which I had invested in, is a listed company called Polymedicure, which did extremely well, very good entrepreneur. And even at Kotak, I was involved in multiple transactions, including companies in the financial services space, medical device space, and in the EMS space as well. So pretty much across the board, companies generating very strong returns for the investors have always aimed to generate that alpha for the investors, and that's basically been my track record.
Sure, Ankit. So now, if investor has to select between investing into category 3 funds or, I would say listed space versus the unlisted space, and if you were to kind of, put yourself in the investor's shoe to answer this question, we know that yes, markets are high, valuations are high, but there is very high degree of liquidity that one gets when one invests in the listed space versus the kind of opaqueness and illiquidity risk which is there in the unlisted space. But at the same time, in unlisted space, as you mentioned, that there could be a illiquidity premium that one could get, and hence, which whereby you are trying to convey that one can get transactions at relatively lower valuations. And the value style of investing that Abakkus is known for is something, which is more, I would say, probably possible at these levels in a more logical way, with regards to finding out your type of good managements. And hence, investing into category 2 fund through Abakkus is something that you guys have thought of. So we understand, that this is the context. So we understand that. But from the point of view of investor, when one has to kind of select, between a listed and unlisted, how should one kind of, understand the entire, I would say, risk reward context, and then kind of make up his mind?
Yeah. No, so see, Kamal, when we look at investing, right? public markets have had a fantastic journey since COVID, right? Where the returns have been north of 25% CAGR. In fact, last couple of years, last 1 year has been very, very good. We believe that markets, the return expectations should be more, would be on the lower side compared to what has been historically the case because of the valuations. Therefore, our aim is to generate that 6 to 8% alpha over the listed side for the investors. And in terms of asset allocation also, I think obviously there are a lot of people who can guide each member, but we believe that a certain amount of allocation should also be given to the unlisted side, right? And that's primarily because there is that illiquidity, but at the same time, you are able to get companies, we are able to get companies at much better valuation, very good businesses which need that growth capital. And we are putting the guardrails in place that we are able to return that capital with a higher return. That is our aim, right? So in terms of asset allocation, some portion of portfolios should definitely be allocated towards unlisted side because that alpha generation can happen. And to be honest, when you look at the amount of money which is there on the listed side, when it comes to the late stage, mid to late stage side, there is not even like 1% of capital which is allocated towards that. And that's why we believe that there is an opportunity to play in that mid to late stage companies where they need that capital for the growth. But not many funds are really focused on that sort of stage.
So in the listed space, it is like quite easy to identify companies, but obviously it's very tough to identify companies in unlisted space when you're going to raise 2,000 crore. How will you identify so many companies for you to deploy this 2,000 crore over a period of say next 2 to 3 years?
Right. No, so Kamal, I think great question, right? See, we've all been in the industry, and our aim is to continue, like the way we evaluate companies on the listed side, it is to find companies which are getting ignored for whatever reason, but good businesses, good management. Aim is to do that. And we have obviously many tools through which and network through which we find a lot of companies. So like already we are in discussions with about 5 to 6 companies where 2 are in exclusive discussions. And the remaining 2 we are in active discussions where we are evaluating the business. So there's already a very active pipeline that we have. And again, the network is we have a very strong network when it comes to public markets. So we are in touch with all the bankers. I myself come with 15 to 20 years of private equity experience. And so there's a long, so we have a network on the private equity side, on the public, on the banker side as well, plus our own network. So we think that deployment of capital should not be a challenge for us, and finding that those good quality companies which need that capital.
Why would those companies, want to add you as one of the shareholders in their companies? Because you guys do not have a, I would say, branding of being merchant bankers or investment managers. You are not in investment banking, that's not your background.
Yeah.
But why? What value would you add from that promoter's point of view is what I'm trying to understand.
Yeah. See, as you know, we have a very strong public market track record. A lot of these companies actually want to, there could be companies which go IPO directly, but companies with investors like Abakkus, when they are on the cap table, there's a lot of comfort which a lot of investors will have, right? Then there is a lot of handholding which is needed in terms of processes, in terms of guidance, preparation for IPO, etc. That is something which we will be guiding them through that journey, right? And also there's a different set of preparation which needs to be done when you go for your listing, post listing, how to. So I think a lot of help and guidance that is needed. That is something which we can provide to provide to our partner companies where we invest. And there's a strong value which these companies also see when we come on board for on their cap table. And benchmarking is done. There are a lot of value add which is done, and also that capital which is needed, right? Otherwise, they have to prepone the IPO, the size of the company will be much smaller. So there are a lot of advantages which will come in when we come in on a cap table for a company.
Sure, sure. So, what is the target number of companies for 2,000 crore fund?
About 15 to 20 odd companies.
Right. So, broadly, you're saying if say we assume 20 companies, around 50 crore per company.
About, again, depends, right? So 1,000 crore plus 1,000 crore depends. So it's 2,000, then yeah, about 100 crore per company possible. Again, that's why I'm saying 50 to 20 odd companies.
So, which means you will be trying to invest at a valuation of say 1,000 to 2,000 crore.
No. We can invest in companies which could be slightly smaller or slightly larger also. So we can take so our stake could be anywhere between sort of say low single digits to double digits, say 15-20% also.
Right. And how many companies do you think you will be exiting, say, in offer for sale or after IPO?
So we don't have any lock-in, so we don't have to do OFS. We can sell it at any point. So that lock-in, we don't, as a Cat 2, we don't have any lock-in. So that will be up to us. See, we'll have a valuation framework which we'll have for each company where we are investing. So we'll obviously want to stick to that. If the valuation, if I'm expecting say 1,000 crore valuation and the company is at 2,000, 3,000 post listing, right? Then I'm happy to get chips off the table on those particular investment. If the company is not moving, but we think there is a lot of value, we'll hold on to it. So it totally depends on how the company does and how the stock, how the market really perceives the company's valuation.
Sure. So let's assume that you have identified a good set of companies, you have done investments, and then after that, if company doesn't go for IPO for any reason, how will you then exit?
So we'll have our protective provisions which we'll have in place. So obviously a company needs a certain amount of time for the preparation of DRHP, etc. But once that is done and then there is suddenly a change of thought, we're happy to exit it to another private equity fund if there is interest in the company. If that doesn't happen, then after a certain point, we will request, basically we'll have it in our documents that the company has to do a buyback or a promoter has to do a buyback. And if not, then we are free to sell it to even strategic investors. Obviously, we'll have our drag along rights as well. So there will be enough protective provisions for us to ensure that we get our exit in a timely fashion if the IPO doesn't happen in a limited period.
Sure. So you said that there will be some protective provisions if IPO doesn't happen. In technical terms, when you will do the shareholding agreement, what are those?
Yeah, so that's the thing, right? So basically, after our diligence, we have a shareholder agreement and a share subscription agreement. We'll have those where we'll have certain clauses that in a certain time frame the company has to go for an IPO, right? If that doesn't happen, then the other rights kick in, right? Obviously, at the same time, as I mentioned, we will be, if there's a private equity fund who's very keen on investing in the company, then they can buy our shares also. Otherwise, we'll have our protective provisions, which are tag along, drag, which is at the last, buyback, share buyback by the company or the promoter, where they have to provide us exit at a predetermined IRR or a fair market value, depending on the negotiations.
So all those, I would say, provisions will be put in every shareholder agreement.
Yeah, it ideally is put to have certain protective provisions with the company, right? Again, certain commercial understanding we may have depending on the company and the discussions. But yes, that's the broad aim.
Sure. So, going back to your track record, when you mentioned about some deals that you had done, if you had to talk about, say, 2 very good deals and 2 kind of bad deals, how would you answer this part?
One company which I can talk about is a company called Polymedicure. It's from my firm before I was at Kotak. It's a fund called Lighthouse. It's $1 billion consumer healthcare focused fund. So I had invested in a company called Polymedicure. It's India's largest medical consumable company in India, and where we were, me and the partner were in touch with the firm for 2008 to like about 12, 13 years, where the founder didn't want to raise capital, but we ended up coming in, and we kept in touch with the company, and when the right opportunity came, we invested in the company. The company has gone up about 4x in a 3-year period, so done quite well. And yeah, I think the company continues to grow well in the in the listed market, and it will continue to do. I believe that it's a strong company, will continue to do well going forward as well. One more company I can talk about is a company called Aadhaar Housing, which recently listed. Had invested in that company. Again, one of the largest housing finance companies. Again, did extremely well, went for its listing. Market is appreciating what the business is and how well spread out the business is. So that's about a couple of deals which have done extremely well. I think there are, obviously, everybody has transactions. I would not like to name companies, but I had invested in a company which was growing at a very fast pace, but realized that the unit economics of the company were not very good. So the company is working towards fixing its unit economics, and that's why when and the company will come out of its current state. So we had a markdown on that particular investment. But again, the aim is, and that my biggest learning from that experience is, invest in businesses not where the capital is needed to fund the burn. It is to invest in companies where the business model is extremely good and the unit economics are figured out. I think that's my biggest learning, to invest in companies where they're not figuring out the business and they don't need the capital to burn, but where the business is already set, the growth capital is needed for further expansion or deleveraging balance sheet and so on. So that's the biggest learning for me on the company which didn't do too well for me.
Sure, Ankit. Tell me one more thing, with regards to now when you will be raising, say, 1,000 crores in Abakkus, what is your role going to be?
So you mean my role will be, again, I'm a fund manager, right? So I'll be involved on the fundraising side. Parallelly, I'm also evaluating companies and evaluating them to see whether they meet our framework and if these companies can generate that alpha for our investors. So that is basically going to be my aim, and then working with the company. So fundraising, then obviously deal sourcing, then getting the deal done through the SHA, SSA, signing those and getting the deal funded. Depending on our stake involvement with the company, it could be, it totally depends on the company and how much guidance they need, because a lot of times companies don't need so much guidance as well. So that will be the aim. And then after that, once that is done, guiding them through that IPO process and how to rightly position the company so people understand the business and are able to appreciate the business once it goes for its listing. And then eventually exiting the business, right? And then returning the capital back to our investors as and when we can get liquidity. And yeah, that is the aim, for us to generate that alpha, create liquidity, and give that appreciated capital back to the investor.
So while valuing the business in unlisted space, how does it work, versus the listed space?
So the fundamentals are the same, right? I think you are looking at, again, good company with a good market, where we believe that this company is management has that ability to really grow much faster than the industry, and buying them at a lower valuation. And where we think that there are low hanging fruits where we can guide the company a lot better, the aim will be to do that. the valuation bench, the way we'll approach companies will continue to be the public market framework which we've used well. Aim will be to continue doing that.
Sure. Do you see, over say next 2 years or 3 years, this entire process of fundraising getting completed and entire portfolio getting constructed, or you think it can happen even quickly, even lesser than 2 years?
Yeah, fundraising should happen ideally before 2 years, because our aim is to deploy capital for the investors. So we believe the fundraising should happen much sooner than that.
Fundraising, I mean, obviously fundraising will happen maybe next 3 to 4 months itself, given it is
right.
Abakkus and distribution network. But I'm talking about the drawdowns. So the drawdown, indicative drawdown cash flows, if we have to talk about, you have mentioned 3 years, right? But would it be broadly 2 to 3 years? Or it can be less than 2 years also.
I think it can be 18 to 24 months, depending on our transaction. But I think that practically will be the case. But we have 3 years to deploy.
Sure.
That's the approval you take.
Sure. So let's assume that in August, September, October, 3 months, the fundraising is done, and from there onwards, fund is closed. Now fund is on the drawdowns kind of raising process. What is the communication that fund will maintain with those investors, 1,000 investors who have come in the fund? What is the rhythm of communication? How would fund those investors get to know about the growth in NAV? What process of fact sheet, like with Abakkus, this communication part is very strong, and all investors like habitual of getting monthly commentary, and obviously in the listed space one gets to know about the NAV, right? So how would it work in the unlisted space in category 2?
Yeah, so the frequency most likely will be quarterly, depending on, again, as we are building the portfolio, but communication will be quarterly, and we'll give more color in terms of how the companies are doing, and some details, as long as the company is not filed for its DRHP, but then they go into the silent period. But whatever information that can be shared with the investors, we'll try to do that, so they have a good idea of how the portfolio companies are doing, and they also get a sense that yes, these companies are doing quite well.
And how will NAV actually move? What are the factors that will drive NAV movement?
So it will be dependent on growth, right? So we have a third party valuer who will value the company every 6 months. Maybe we have to see, because 6 months also is quite frequent, but the frequency will be like, so the third party valuer will value the business basis other public market comps and so on, other factors through which they feel like where we are in terms of liquidation preference and a lot of those things which come into play, which they will decide, and they will assign a value to each of our investment. And basis that is when every 6 months the investors will get a sheet which shows where the portfolio stands today, every 6 months.
Sure. So you mentioned that manufacturing infrastructure, energy, power, as some of the energy, power, and pharma as few ideas from where the portfolio could be constructed. You want to kind of elaborate that part in terms of target profile of businesses, from what sectors you see these companies coming out?
Yeah, no, so it's going to be a sector agnostic fund, Kamal. So we are going to look at all companies across sectors, manufacturing, infra, consumer, healthcare, financial services. These are some of the core areas for us, because we believe that these will benefit hugely from the Indian economy moving from 4 trillion to 8 trillion. So we'll look at all businesses in that space. It could be B2B, it could be B2C. It totally depends on the merits of the company and the valuation we are getting. The couple of companies we are currently in advanced stages are both B2B in nature, but that's a early pipeline which we have, right? Even the other two companies are B2B and one is B2C. So yeah, so overall, again, portfolio will depend on the type of opportunities we get, but aim is to ensure that, because very difficult for me to say like which sector will end up getting good valuation companies, but The aim is to also be bottom up, where we are not investing just for if it's a hot sector, then we end up coming at 100 PE or something like that. That is not the DNA of Abakkus. We will be value conscious when we are looking at and evaluating these businesses.
Sure. So mostly, whenever new funds of Abacus have been launched, the timing of those have been very good. So it's like always thoughtful, and I hope the same this time, and I wish you very good luck for that. But one thing which I'm sure you added, there's this principle that 15-15-15 rule, which Abacus is known for. It follows, in terms of entering at a lower PE less than 15, and obviously, companies are growing at above 15% and then maintaining 15% plus ROE. So how would you will the same, I would say, principle apply in this fund, or you will have to tweak it some way because it being an unlisted fund?
No, again, see, the philosophy is similar. Now, some companies may be growing more than 15%, where valuation is slightly higher. So again, we'll stick to that principle, but you obviously cannot. It's not a hard line, right? Becomes very difficult to then do transactions. But yeah, we are looking at companies with good ROE profile. We are looking at companies with good growth profile, and I can tell you that we are not looking at companies with that very, very high PE or EV beta, or valuing them on like price to sales multiple because the profit is not there. That is not the game.
Sure. What is going to be your personal skin in the game?
So I have I'm going to be investing personally as well in the fund, and I have my economics also with the fund for the fund to do well.
Understood. Perfect. Anything that you think is relevant, because you told me that you have 40 minutes because you had to move out for some other meeting, but we have last 2 minutes. Anything now you want to conclude that what is it that one should expect from this fund, because you are the one who is going to be the face and I would say person who's going to set the expectations. So rather than I concluding it, if you would want to conclude it, I offer this to you.
Great, Kamal. Thank you so much. No, I really want to thank you for the opportunity, for letting me talk about the fund for Abakkus 428 Opportunities Fund. I think this is a fantastic opportunity. We believe that there's a big white space in this particular opportunity, where we are able to come in before the IPO of a company, guide them through that process, and generate that alpha for all the investors. That is going to be our aim. And as our aim will be, as Abakkus has done well on the public side, we aim to replicate that also on the private side.
Sure. Thank you so much, Ankit. So there have been few questions that audience has been asking on fee structure. For your understanding, everyone, it's 2% fixed fees, 10% huddle, and 17.5% of performance fees. And performance fees is without catch up. But yes, all these particular discussions about the product we can do one-on-one. You can come to our platform, book an appointment with us. You're most welcome. And I see most of the people in the audience are our existing clients. So it's my, I would say, humble suggestion and request to all of you to kindly, respectively connect with us, and we'll happy to answer all your questions. We have our own understanding and opinion about the product. And yes, this is a product which is not meant for all, but who are those clients and what is the kind of risk appetite required, what is expected out of the fund is something which we can really guide you and advise you very well. So thank you so much, Ankit, for your time today. I think it was a pleasure connecting with you. We'll again reconnect maybe in some time, because I think once the fundraising reaches a certain stage, we'll have to again reconnect with you to understand how the fund is closing and how the fund is doing. Maybe by then you will be able to talk about few companies also which you have identified. As of now, it's like too early to comment on that. But really,
but there were a couple of companies. I'd mentioned a couple of companies, but yeah, we'll definitely discuss them in more detail.
Absolutely. Yeah. Perfect. Thank you so much.
Great. Thank you so much. Thank you so much. Okay. Bye, everyone.
Thank you.